Welcome back from the sidelines of the JPMorgan India Investor Summit. We're now joined by Oganes, the head of currency, commodities and emerging markets research at JPMorgan. Louis, thank you very much for joining in. My first question is on the big event, right? FOMC, the Federal Reserve has already said it's going to be higher for longer. What does this mean from a currency point of view? The dollar index is still hovering around 110, and even from bond yields, because we are at the highest level since 2011.
Thanks, Manisha. Thanks, Manisha, for having me. The prospects of more Fed hikes means that the dollar strength that we have seen so far is probably not going to end anytime soon. At some point, reserve currencies do tend to, mean revert, but at this stage, we don't see any trigger for the dollar to start weakening on a sustained basis. So the dollar strength that we have seen so far this year, that is accumulating now in nominal effective exchange rate terms to like a 5-decade high, probably is going to stay around these levels for some time, certainly until we don't have clarity how much more the Fed will need to hike. And given the inflation dynamics, that is still an open question.
Louis, when you say that you expect the dollar index to stay higher, I mean, are we looking at levels like 111, 113? I mean, that is what the street seems to be talking about now.
Well, it is certainly possible. When you look at the, just looking at pairwise, various components, we're expecting 95 for euro dollar. We're looking at, 147, potentially all the way to 150 for dollar yen. We're looking at 110 for sterling to the dollar. And EMFX, obviously, on the losing end of this situation, and to the extent that it's very difficult when the dollar appreciates against other reserve currencies for EMFX to do well. We're expecting actually the CNY, the Chinese renminbi, to also weaken, go past that 7 threshold, potentially to 710 over the next year. So in that environment, probably we're going to see further gains in the DXY.
All right. So it's not just the U.S. Fed, because we have seen front-loaded tightening elsewhere in the developed markets as well. What does it really mean for the emerging market central banks? Do you see more vigilance? Do you see more action here?
Yes, I think that central banks around the world are certainly, on the developed market central bank side, they are all fast-tracking, front-loading their tightening. Interestingly enough, this week we do have 6 G10 central banks scheduled to have monetary policy meetings, 5 of which are expected to hike, in clips of 50 to 75 basis points. In the case of Swiss, it could even be higher. We don't know. The only one that is missing in action is the Bank of Japan, but certainly there's still quite a strong momentum given the inflation dynamics for them to deliver more. EM central banks have been hiking already for quite some time. It started last year, certainly earlier than DM, but given the inflation dynamics, to the extent that it's not yet peaking everywhere, probably the pressure on them is going to be to continue. Certainly, if the Fed goes on, it is very difficult for EM central banks to stop all of a sudden.
Absolutely. Louis, also, when you look at the China zero-COVID policy, I mean, that is impacting the developed markets and the emerging markets as well. How much of a bigger concern do you see that in coming couple of quarters?
Well, certainly something that has been, I would say, one of the key drivers for disappointment with the recovery in China, right? We had a very tough second quarter because, important sector of the Chinese economy that is good, key for manufacturing, was under lockdown because of the Omicron variant. Certainly, we were expecting a very strong rebound in this third quarter. I would say that the risks are to the downside and then to continue in the coming quarters ahead. Our economies have already downgraded the second half of the year recovery, and next year we're looking at a growth rate of maybe around 4.5%. But certainly the risks seem to be on the downside, and this is related to Chinese reluctance to abandon this zero-tolerance policy towards COVID. Potentially next spring, certainly you don't do this in the winter when there's a risk of more hospitalizations and the like. Maybe next spring you may see some relaxation of some of these measures, but we're not there yet. So I think that for the time being, you're going to have this policy probably conspiring against economic activity in China.
Clearly that. Louis, I was reading the report that you sent across to us, and even as many of the asset classes clearly are in the negative as we look at them YTD basis, but equities have declined more than what commodities have seen. How would you, how would you rate the performance that we've seen between various asset classes?
Well, commodities certainly, in an environment where China decelerates, that is, potentially going to put some dampener in commodities that are linked to, in general, China or the global business cycle. We're talking about base metals, potentially even oil. Certainly in our own projections for oil to still close the year, near 100 and to moderate to the mid to high 90s next year, does informally incorporate the risk of a U.S. recession. But certainly to the extent that the Fed needs to keep going, the probability of recession goes up. So that is probably something that eventually may need to be reflected in commodity prices.
Louis, a couple of things then. One, how do you look at India amidst all of this with what the central banks are doing? How would you rate that performance? And what's your sense, since India is one of those countries where we import a lot of industrial commodities, crude for one, and many other base metals the second, how are you looking at India's chance as we move into the next year?
Well, the situation with India is, one where the central bank obviously has been tightening and probably has more to go, partly because of inflation dynamics, partly because of what DM central banks, particularly the Fed, is doing, right? So it is very difficult for EM central banks, as I said before, to stop their tightening cycle if the Fed keeps going, because that continues to put pressure on currencies, that continues to put pressure on capital outflows, and the Reserve Bank of India will probably need to respond to that. What has been happening, though, is that the RBI has been intervening in the FX market. So a lot of these dynamics haven't been necessarily reflected in the currency. But at some point, something needs to give. Either they hike more, or they let some of this steam go through the FX market. Certainly, there is ample reserves in this country, so this policy can continue. But if the Fed continues to hike into the winter, spring next year, sake of argument, at some point there will need to be some rethinking here as well, because using so much of reserves becomes a bit of a futile exercise. At some point, probably even to support growth, support export competitiveness, to help narrow the current account deficit, which is bordering 4% of GDP for the full year, you will probably need some weakness in the currency.
And taken. I have one final question on commodities as well, Louis. And what do you see there? The gold and silver prices have continued to decline. The base metal prices, even as they hit near all-time highs in this year, have come off as well. What is your sense on prices and demand here?
Sorry, Manisha, you got cut off. I didn't get your full question.
I was trying to get you to tell us on what you expect on price front when it comes to metals, precious metals and industrial metals, base metals, that is.
So base metals, certainly because of, we're seeing weakness in global manufacturing. We're seeing weakness in or disappointment in the pace of recovery of China. So I think that there is certainly downside risk for base metals. For precious metals, it's an interesting, we're in an interesting moment. Let's focus on gold. Gold, the correlation between gold and the real 10-year yield is in the U.S. is quite close, even though it has been weakening of late. The fact that the Fed is hiking means that the real policy rate in the U.S. is no longer as negative, and this means that there's less need to use gold as a hedge. However, going into next year, the expectation is that at some point the Fed may need to actually push the brakes sufficiently on the U.S. economy to bring inflation lower, and that may also spell a start of a decline in interest rates. At that time, we may see gold once again resuming its upward trend. So our specialists have a forecast for the price of the ounce of gold, of $1,650 for the fourth quarter of this year, but ending up above $1,800 in the fourth quarter of next year.
Okay. Hi, Louis. Good morning. I was listening into the conversation with you and Manisha on the currency space. This is Pavitra. I thought I should throw in one on the cryptocurrency space as well. We've seen a huge crash. Bitcoin is now down over 50% in the past 6 months. Of course, we've seen what's gone down with the Ether prices as well. What is your sense on this entire space, and do you think there's room for a lot more of a fall?
Well, certainly while the Fed continues to tighten, it looks like, some of these, risky assets that relied on cheap money for so long are probably going to continue to suffer. So I don't think that this spells the death of cryptocurrencies. I'm sure that at some point there's going to be, some, that new asset class, is going to find its footing and its demand. Remember that, cryptocurrencies is still largely a bet on the future. No one knows exactly what is going to be the ultimate source of demand for these cryptocurrencies. But I would say that in the coming quarters, while the Fed is still acting, tightening, I think that it's going to be a very tough environment for cryptocurrencies because, again, they were favored as an investment destination because of easy money, cheap money. That is no longer the case.
Yeah, I guess it's in general people just pulling out of risky assets, right? But Louis, thanks a lot for joining us today and taking us through your outlook on the entire currency as well as commodity space. We're going to leave it